How much higher will the stock market go? I really struggled with the title and script for this video because the equity markets look healthy and no one will want to watch a boring video of how great things look. Aren't we always attracted to fear more than we're attracted to a video about how good things are? It's always better to instill fear, uncertainty, and doubt to get more viewers. Or is it? Look, the best way to grow your wealth is to start by saving and then use your savings to invest in a business or businesses. The business can be your own startup, or if you're not cut out for that, then invest in the business of others through either the public or private markets. Notice I didn't say invest in a stock. Invest in the business and hold that investment until you don't believe in the business anymore. Don't sell your ownership stake just because the stock price has dropped if the business is still a great one. In fact, buy more. It takes guts and a clear head, but then growing wealth isn't for everyone. If you don't have the time nor the inclination to do the work it takes to be an investor, then find someone who loves doing that and let them manage your money for you. If only I knew of someone like that. That's my lecture for the day. So given that little speech, let's see what the metrics are showing us about the current health of the stock, bond, gold, and crypto markets. Let's take a look. So if we take a look at the equity markets over the past week, you can see we had a very healthy rally here. ARK and the NASDAQ 100 finished in first place, followed by the S&P, followed by the Dow, and then followed by small caps. This is a very healthy stock market rally. Things look great. What about over the past month? Same picture. ARK leading the way, NASDAQ, S&P, and small caps, and the Dow. This is exactly what you want to see. And what if we look at year to date? Again, a great picture. ARK leading the way, NASDAQ second, S&P, small caps, followed by the Dow. This is the perfect picture of a healthy stock market. I don't normally show this, but let's just look at 5 years. I want to point this out because you can see that while ARK is still selling for a discount from where it was 5 years ago, it's down almost 5% from where it was exactly 5 years ago. It's heading up. And my belief is if the markets continue to look good and perform well over the next several months, we'll see ARK eventually move up here. So what are the current bottom dynamics telling us? Well, if we look at this chart, there's not a lot to see here. Obviously, the S&P is moving higher. The bottom confirmation signal is fairly high here with a fairly high risk confidence level. This is healthy. This looks very good. And you see that the safety confidence level is very low. That's also good. That's also indicative of a healthy equity and risk market. What about risk versus opportunity? Well, if we look at this chart, this looks great. I mean, you've got risk, which is the red line, falling here. In fact, it's well below 80. 80 is the level where I become concerned. This is well below that down here, just above 50. We've got risk acceleration down here below 20. I think it's at about 15. And then the opportunity level is at a very nice high level here. This looks fabulous. And when we look at equity versus safety, remember these move fairly quickly. Love the fact that the NASDAQ 100, the Qs, have stayed in the number one position now for at least 7 weeks. In fact, the week before this, they were also in the number one position. I also like the fact that cash, while it's moved around a bit here, is now falling and is below the middle position. This is great. I would like it to fall even further, but I'll take this. This looks fabulous. And also the fact that you've got the NASDAQ 100, followed by SPY, followed by small caps, and you've got the Dow in fourth place here in the equity bucket. This is very healthy. These are the least risky stocks. These are the higher risk stocks. And you want these to be ranked number one and Dow number 4. This looks great. And I like the fact that the Treasury markets are also very healthy. You have EDV, which are the longest duration Treasuries above TLT. Now these are still a little bit inverted here. SHV are less than 1 year. IEI, I think, are 3 to 7 year treasuries, roughly. So you really want IEI to be above here, but I'll take this, and gold is down here near the bottom. This is a very healthy looking equity market and a very healthy looking treasury market. And how does all this show up in the buying and selling pressure? Well, it looks pretty good. If you look at the Dow, we've had a nice rally here. The buying pressure was well above the selling pressure. Now it looks like they could potentially invert going into next week, but we won't know till we get there. S&P 500, very nice rally. Buying pressure well above the selling pressure here. The NASDAQ 100, same picture, very nice rally. Buying pressure above the selling pressure. And ARK Innovation, a very nice rally. Now the buying pressure is not as definitive here, but it's not in a bad place either. So I like what I see here. And if we look at small caps, very nice rally here, pretty jagged, but the buying pressure has collapsed and the selling pressure is increasing. So it'll be interesting to see what happens with these next week.
Hey, I got a confession.
And if we look at the sector rankings, this is the longer view. These sort of move more slowly. The top table here is how these things looked last week, a week ago on Friday, and this is how they look this week. And you can see that this week they are very healthy. You've got technology, Bitcoin, ARK Innovation, consumer discretionary. This is a dream. This is a very healthy risk appetite. Now, I don't like the fact that consumer staples have moved up a bit, but I don't dislike it either, because what this tells me is you've got fear of missing out happening here. Investors, value investors who sort of missed the rush into the riskier assets are now looking around and going, what hasn't performed as well? Oh, consumer staples. I'll put my money there because those are fairly safe and they haven't performed as well. So I'm going to put my money there. That's kind of a fool's game. You need to be an investor, not a trader. But that's what I see happening here. And I like the fact that cash has moved from last week up here down to here, and gold has moved down. This is a very healthy looking risk appetite, in my opinion. And what if we look at sector rank acceleration? Now these move much more quickly. So you can see that consumer discretionary and cash were up here. Now consumer discretionary has moved down a bit, but look at what cash has done from last week up here to this week. It is just tanked. It's just plummeted down here to the bottom. Love this. Now again, this consumer staples moving up here, I think is in line with my thesis that value investors are saying, what hasn't gone up as much? Oh, consumer staples. Let me put my money into those because they're safer and they're lagging and they're a better value. Okay, well, we'll see how that plays out going forward.
You used to have to work for that.
And how have treasuries looked over the past week? Well, if we look at treasuries, this looks fairly healthy. The highest risk treasuries, EDV, purple line, are finished the highest, followed by TLT, and then followed by the safer treasuries, which actually finished the week negative. So this tells me there's an appetite for fixed income risk. Investors are putting their money into longer term bonds. And over the last month, similar picture. And if we look year to date, they've kind of gone nowhere. But again, the highest risk treasuries are leading the way here. So this is a fairly healthy looking picture. And these are still selling for near their long-term lows. So these could still be a bargain going forward. But whether they're a bargain or not depends a lot on the Fed. So let's take a look at that inverted yield curve. Yep. Boy, I got to tell you, this doesn't look good. So if you look here, we were inverted by 1.1% or 110 basis points back here in March of this year. Now, things tried to recover here, but they only got to a level of about minus 40 basis points. And now they're heading back into the doldrums here, minus 95.7, almost 96 basis points inverted. Why is this happening? I'm not quite sure, but it might have something to do with the Fed's posturing, saying that, oh, well, they might still raise another 0.5%. And you can see that here in the Fed rate monitoring tool, the markets are saying that there's a 75% likelihood the Fed's going to raise interest rates by 25 basis points or 0.25% the next time they meet here. And there's only a 25% chance they'll leave them flat. So I think you're seeing some of that over here in the inverted yield curve. So how does this all show up in the buying and selling pressure for Treasuries? Well, if we look at SHI, which are short duration Treasuries, I think 1 to 3 years, you can see the selling pressure is well above the buying pressure, and the price has been declining. We look at IEI, a little bit longer in duration, again, declining price, selling pressure above the buying pressure. What about IEF? These are 7 to 10-year Treasuries, so I call them intermediate to long Treasuries. Again, price declining, selling pressure above the buying pressure. And then if we look at long bonds, 20-year Treasuries, you can see that while the price declined here, it's now increasing. And that goes along with my thesis that investors are putting their money in longer-term Treasuries and staying away from the shorter duration Treasuries. And you can see that the buying pressure is above the selling pressure here. So this looks good for long bonds going forward. What about gold? Yeah, I gotta go mine some of that stuff. Well, take a look. Price has been declining. Now, it's been kind of going sideways lately, but not much happening here. So this is typically an asset that people put their money in when there's geopolitical risk. So, something bad happens in the world, this could go through the roof fairly quickly. And it's also an indication of inflation. And, the Fed's saying and posturing that they're going to raise interest rates again, but there's nothing here. So I don't know what they're talking about. And what about crypto? Whoa. This was going nowhere because of the SEC cases against Coinbase and Binance. But recently, I think BlackRock announced that they're trying to do a Bitcoin ETF. And look at what happened. Whoop! Right up there. And you can see the buying pressure shot up with it. So be interesting to see if this is what I call a news/noise event and things return to where they were, or if this has some legs and this continues higher. But really interesting picture here. I'm going to sound like a broken record here, but if we look over the longer term timeframes like year to date and shorter timeframes like this past week, the equity markets look very healthy, and they're still being driven higher by the fear of missing out. Although the sector rankings are showing some profit taking from higher risk equity sectors, with the money flowing into safer equity sectors. And as I said earlier, I don't think this is going to work out well for those investors. Look, there's both a healthy equity risk appetite and a healthy treasury risk appetite. And hopefully, the fear of missing out will continue to drive those markets higher. I'm Calvin Rose, and thank you for watching Invest Smarter this week. Remember, be an investor, not a trader. That's all for now.
What did you say when I told you? Maybe this wrist wasn't gold proof. Packing my bags like it's all true. Hard to make friends when I'm focused on all these bars that I'm holding. I like the cold, but it's lonely, yeah. This life feels like the sunny water.